welcome to the program. I am Bisi Adebayo. Let's kick off with oil prices, which are mixed this morning as a bigger than expected build in U.S. crude stocks and a weaker U.S. retail sales stoke fears over fuel demand, although hopes that OPEC and its allies will delay a planned rise in oil output lend some support to the markets. This morning, we saw Brent crude futures for January up 0.46% to $43.95 a barrel. That was in early trade, and the US WTI crude for December was also up 0.12% to $41.48 a barrel. Now, data from the American Petroleum Institute on Tuesday showed US crude stockpiles rose by 4.2 million barrels last week, and that was well above analyst expectations for a build of 1.7 million barrels. Meantime, members of the Organization of the Petroleum Exporting Countries and its allies, called OPEC+, say they would be ready to cut crude production in order to prevent another slump in prices. At the end of the virtual meeting of the Joint Ministerial Monitoring Committee held on Tuesday, the OPEC+ pointed out that all participating countries need to be vigilant, proactive, and be prepared to act when necessary to the requirements of the market. However, OPEC Plus JMMC turned down an informal request from Nigeria to reevaluate the baseline from which its crude output cuts are calculated, citing that change to oil quota could lead to a collapse in the market. In other news now, S&P Global Ratings has warned that banks could face their toughest year since the 2009 global financial crisis, with four key risks, which are economic disruption, longer-term overhangs, insolvencies, and a weakening in poverty hanging over the sector. In its latest Global Banks Outlook for 2021, the ratings agency gave a negative outlook for about one-third of global banks, with many downward revisions taken in light of the COVID-19 crisis and the oil price shock experienced earlier in the year. For Africa, the agency says Nigeria and Tunisia's banking sectors will be the most vulnerable to the shock of COVID-19, as the pace of the recovery for the banking sector of Africa's biggest economy is expected to suffer GDP contraction of 3.8% in 2020 and of 2% in 2021 to 2022, and that's due to a depreciation of the naira and volatile oil prices. Now, as the days draw closer to the official commencement of the African Continental Free Trade Area, different stakeholder engagements have begun as countries begin to fine-tune their trade policies and business environments, particularly to benefit from the trade agreement valued at $1.3 trillion. The Chapter Chair, National Association of Government-Approved Freight Forwarders, Dr. Segun Musa, joins us now for an assessment of government's readiness from the angle of ports and border operation, plus other issues relating to port operations in the country. And he's right here with us in the studio. Good morning, and thank you for coming on the program.
Yes, thank you very much for having me here again.
All right, let's begin our conversation with getting your thoughts on Nigeria's readiness for the implementation of the EUFTA from your own angle and looking at your industry.
Yes, thank you very much. First and foremost, we need to acknowledge the fact that there's a great opportunity for a country like Nigeria that we've been getting overwhelmed with economic crisis and depreciation in our currency and so many other things that has been affecting us. And I'm expecting the government to actually take a proactive measure this time around so that we will be a kind of beneficiary in this scheme rather than just being a dumping country. Let me start by saying it's a great opportunity for the largest free trade area in the whole world, like we have under the AU, the Continental Free Trade Agreement. We are expecting government to begins to look inward and see majorly the players and how to encourage them in order to be able to participate effectively. Let's start with the ports. Our port need to be business friendly. What we have now does not represent what we are expecting in the bigger picture. We have a kind of port system that the period for clearing of cargo is so wide. You have so many agencies that you have to face bottlenecks here and there. If we are to actually participate in this opportunity, we need to embark on measures that will enhance trade facilitation, because we're going into integrating trading activities. And if we are to participate effectively and play a major role, then it behoves on us to have a business-friendly port. Both the airport and seaport and the border stations.
And so what are some of these measures that we're talking about here?
When you have multiple agencies, it's a big problem. When you have to pass through one table to the other to process your clearance, your import procedure, and every other thing, it's a big problem. When you have inconsistency in government policy, it's a big problem. And let me start with ports. Number one, when you look at the corridor of the port, it's nothing to look holistically as enhancing trade facilitation. The corridor is extremely bad. Because it is not only when you process your document that you've cleared cargo. It is when the cargo gets to the final destination, that's when you've cleared cargo. So there's a difference between conducting an examination and releasing your cargo from clearance of your cargo. Cargo is believed to have been cleared when it gets to final destination. So when you have a corridor that is not business friendly, it's a big problem. Aside that, we have a kind of government policy that is not encouraging business, inconsistency in the policy. Today you wake up, the exchange rate just go up without any expectation. Of course, it kills business. So we have so many challenges in the port, talking about multiple agencies. You have to go through the regulatory agencies. You have, at times, you do have some agencies that regulate, about 2-3 agencies regulating a single importation. All these are bottlenecks to trade facilitation, and it must be looked into.
But these bottlenecks that you have mentioned now didn't just start. They've been there, for so long. So why have these issues lingered for so long? Is it that you have not probably channeled your grievances to the government, or what exactly? Why has it dragged on for so long?
Yeah, over time we've engaged government, and I could remember vividly, about 8 years ago, government actually moved out most of these agencies out of the ports. But you know the kind of politics we always had to our economy in this part of the country, where some of the agencies will say, look, we are under a ministry and we have mandate to be in the ports. And we used to challenge all those discourse. And I think the major problem we have is because we don't have a national interest. If we have national interest, government would have been able to define how the port will be well managed, who are to be in the port. It's not about my ministry said I should be there and I have to be there. There are so many measures all over the world. People are moving ports into a kind of automation that you don't even need to be there in the port. You can regulate whatever you can regulate online. You don't have to be in the port physically. We are still living in the Stone Age when we don't want to move and align with international best practices, probably because of corruption. But somebody needs to bear the card. Somebody needs to call the attention of government that, look, if you want to operate international ports, there are rules and regulations that you must follow. There are protocols that you must follow. And you must engage stakeholders accordingly. And that's the only time we can say, yes, we are among shipping or maritime or aviation country of the world, and we are ready for trade facilitation and business integration. With what we have presently now, if we are to key into the African continental free trade area, you will realize that a lot of people will prefer patronizing countries like Ghana, like Cotonou, like Abidjan, because most of them are prepared.
How are they prepared? What are they doing that we are not doing?
Over time, they've been preparing for this. Why Nigeria never prepared for it?
Would you really say Nigeria never prepared for it, or the preparations are not enough?
I served under ECOWAS as president, representing Nigeria under ECOWAS on trade liberalization. That's Lagos-Abidjan corridor for a year. And during all this engagement, because we are the advocacy group for the trade liberalization in ECOWAS, we do engage most of these stakeholders in other ECOWAS states. And when we discuss, we always realize that we are still far behind. And we do engage government as well, that look, these are the protocols that we need to follow for us to align with the best practices. but definitely it always made the deaf ear. And government seems not to have major interest in the maritime sector and the aviation sector. Government only believes that as much as revenue comes in, whether the port is advancing to that international standard or not, as far as revenue is being collected, I think they are satisfied with that. But the in thing is the ships is down now. Take, for instance, we signed an agreement under ECOWAS for common external tariff a few years ago. We are signatory. And at the end of the day, the essence of that custom external tariff is to ensure that if you are bringing any imports into ECOWAS states, you can drop it in Cotonou, you can drop in Ghana, you pay your custom duty there, and you just transit it down to final destination. When it gets to your border, they will only log in, check where it landed, the duty you've paid, the report from the examination, and they will allow you to go. And the essence of that is just to capture the revenue that has been paid so that the ECOWAS Custom Union will be able to harmonize the revenue collected. That is the essence. But only Nigeria is not prepared, and that's why it was frustrated. Again, when I was serving under ECOWAS, I remember vividly that the project of Seme border, the border in Seme that has just been developed, was 100% financed by European Union. And Cotonou gave us the land. Nigeria never participated in contributing aside our expertise. But at the end of the day, when it was commissioned, the first thing we had was government did not trust this. It's not trusting this, and they have to shut down the border.
But they will have their reasons.
No, the reason, you have to measure the reason. Is it the best approach as at that particular time, when we have so many other measures? You see, you are dealing with other country here. It's not about your own personal internal state. And you cannot sanction other country because there are issues. There are so many approach and protocol that you can follow. I would have expected our government to have engaged the ECOWAS and said, look at this, we can't tolerate this. What do we do? Engage other countries that are also involved. Look, we can't tolerate it. If this continues, this is the measure we're going to take. But you cannot just wake up because we are big and say you want to sanction.
So are you saying that there was no engagement at all?
No, there was no engagement. I started under the ECOWAS. And I condemned it initially when it started. And I said, look, we have so many other approaches that we would have used because it did not affect them as much as it affects our own business community here. Businessmen and businesswomen enterprises, they lost billions of dollars. And government does not even have any barometer to check the impact of that measure. They only brought out the excuse of security risk. And
Which
we cannot,
is a valid
because
point.
It's a point, but there are measures that you would have taken that would have taken care of that. There are so many options. If you're talking about rice, okay, we don't want imported rice to come into Nigeria. Do we have capacity for rice? No, we do not. What we can yield is not up to 1/3 of what we need as local consumption. We don't have to continue deceiving ourselves. A simple economics says you should concentrate on your competence. We have other competence that we can actually develop, and that's brought us back to this Africa continental free trade area. If you have so many competences that you've abandoned, and you're looking at areas that you don't have competence, and you want to force yourself to develop it, you jack up the price and nobody will patronize you. Ab initio, we buy rice for 5,000 per bag. Today, because we want to concentrate on local content, we are buying for 40,000 per bag. It does not make any economic sense to anybody. That is to show we don't have the capacity. Before now, we buy cement for 300 and something naira. Today, we buy for more than 3,000 naira. It does not make any economic sense. And I think government should remove politics from governance. There's a difference between government and governance. Otherwise, you just allow some few capitalists to monopolize the market and destroy the economy.
Now, let's talk more about the issue of the border closure, which, you've actually silently touched on now, talking about the rice now. But has there been any significant improvements in cargo movements since the land borders were shut over a year ago?
No, it has been shown that there's no movement. A lot of investment has been wasted that runs into billions of dollars. And a lot of people cannot even survive it again. This is more beyond, it's far more than what we are talking about NSAS. People lost huge investment because government should have put into consideration that people that patronize this corridor are entrepreneurs that cannot afford to go into China market, go into Asia, America, Europe market. And they look at opportunity within the corridor of ECOWAS to patronize and integrate trade. You are looking at small enterprises that are taking advantage of the ETLS to bring in commodities. Some are perishable, and all these are now waste. Sincerely speaking, I see that as a snap judgment. I see that as an attitude that does not put into consideration the impact assessment, because the impact is huge.
Now, Dr. Musa, one of the issues is the fact that there are 6 ports in the country. But of course, over the years, there's been more traffic, more concentration on the Lagos ports. Why has this lingered for so long?
This year has to boil down to government policy and approach. If we want to be a maritime nation, government should look beyond Lagos ports. And even aside that, we can even, as part of measure that I recommended about 10 years ago to government, that look, it's high time we decentralize Apapa. Begins to look at other corridor where we can bring up lighter terminals. We have Ikorodu, we have Ekpe, we have Badagry, we have so many other corridors that we can open up, we can bring in investments. Investors are willing to participate. All we need to do is just to ensure that we sign an agreement under favorable terms with them, because that has been the major problem with the Nigerian government. When the government signs an agreement with you, you invest your future into the country, and that government will come tomorrow and say, look, you did not pass through due process, and they will kill that investment. And that's why a lot of investors are not coming. Government needs to be very proactive and look at, you see, business is not just about bringing your resources. It's all about operating within a conducive atmosphere, a business-friendly environment. And that's what encourages businesses. A lot of indigenous investors are taking their money outside the country to invest. Not because they cannot invest in Nigeria, but because the enabling environment is not there. So if some of us are investing outside Nigeria and the foreign investors are seeing us that we are rushing out, of course, they will say something is wrong. Why are you not investing in your country? Why are you coming to our country? And that is a major problem. And for instance, the approach to the closure of border now is affecting most of us that also have investment outside Nigeria, especially in Ghana, Abidjan, and the rest of the countries, because they are now hostile to us. They look at our country as, because we are big, Nigeria would have done that if we are as small as Cotonou. This is economic sanction on those countries. Although it has more bigger effect on our business community, but it's a sanction. And the law, the international treaty and protocol does not allow any country to do that. If under a situation we have a real ECOWAS that is operating accordingly, Nigeria would have been sanctioned. You don't do that. You don't muzzle big, smaller countries just because you have the strength. You don't do that.
But there were so many reasons why that had to be done.
We've mentioned the
Nigeria
reasons.
was literally becoming, a dumping ground, and then smuggling and all that.
If you don't want to be a dumping ground, what capacity do you have to satisfy your local consumption? I've just talked about rice. In Nigeria here, if all the fertile land for rice, if we fertilize, we manure, we do every nutrient we need to put in it, we will yield just 1.3 million metric tons per hectare of rice. And Nigeria needed almost 3.6 metric tons per hectare to satisfy our local consumption, not for export. So how are you going to complement the remaining that will satisfy our local consumption? Now, we don't even have the land with enough nutrients to grow that. So what we are producing as of today is 0.2 point something metric tons per hectare. And we need 3.6 metric tons. And that's why you have rice jumping to 30,000, 40,000. And it's still going to 100,000. So it does not make any economic sense.
We hope it doesn't get to that point.
No, what government needs to do is just to use import to complement. Even in the days of pyramid of cashew, pyramid of cocoa, we are fully into agriculture. We still import rice. You remember Uncle Ben's? You remember so many rice we do bring in. But that does not kill our economy. What government needs to put in place, when you are importing this rice, the revenue collected on those rice will be channeled into a pool that will support local content. People that want to go into rice farming, milling, and the rest will be able to access loan at 0%.
Okay.
so that to be able to compete with imported rice.
All right.
And by the time you continue improving on the quality of rice, definitely people will begin to patronize you. It's
All right.
not a rocket science thing.
I know we could go on and on with this conversation, but time would not permit us. We'd like to thank you, Chapter Chair, National Association, or the Deputy President. Oh, wow.
In charge of all the airports in Nigeria.
Oh, fantastic. Thank you very much for that clarification, Dr. Shegun Musa. Thank you for coming.
Thank you for
on the
having me
program.
here.
I appreciate your time.
I really appreciate it. Thank you.
All right, we'll turn our focus to expectations from the DMO bond auction when we return in a moment. Please stay with us. Welcome back. The federal government will offer around 80 billion naira through the Debt Management Office in its bond auction for November. Now, the auction will see the reopening of a 15-year and 25-year papers, while the bond settlement takes place on November the 20th. Well, this is coming amid the diversion of funds from the debt markets to the equity market. But let's talk to the acting managing director at Cordus Asset Management, Gwalao Aina, for more on this. Good morning, Mr. Aino, thank you for joining us on the program. So around 80 billion naira worth of bonds on offer for subscription this morning by the DMO. Do you see some oversubscription as projected by other analysts or otherwise?
Good morning, BC. Thanks for having me. So for today's auction, really I expect an oversubscription. If you take a cue from what we had last auction, was more than 5 times oversubscribed. Look at the bid to cover ratio. Today, the DMO is having to reissue, like you mentioned, the 15-year term to maturity and 25-year term to maturity. From the last auction, they were going to raise just 15 billion, but they took 45 billion, and they were allocated a competitive bid of 4.97% for the 2035 and 6% for the 2045. But run up to the auction, we've seen a lot of bullish trade in the bond market, with investors taking a lot of position. There's huge system liquidity. We expect to see some of those funds come into the debt market today. So I expect an oversubscription. I expect the 35-year maturity to close between 4.95 to about 5%. And I expect the 2045 maturity to close around 5.95 to 6.15%. It's interesting to mention that the run up to the auction, about 40 basis points has been lost in terms of yield. And that speaks to the fact that a lot of investors, local fund managers, and PFAs have been investing in the bond market. But we've seen a lot of reinvestment at the lower end of the curve, and that's because more maturities have been reinvested at that level. But we expect that after the auction, we expect to see some bullish trend at the upper end of the curve.
Now, just like you alluded to now, there's more than enough liquidity in the financial system at the moment, which of course could possibly fuel the subscriptions today. But how do you expect that to shape the stop rates and why?
So because of excess liquidity, and we expect PFAs, investors to want to ensure that they get their bid. So I expect people are going to bid quite low just to be sure that they're able to get into the auction. So I expect to close lower than it closed on previous auction. Like I mentioned, previous auction, the 2035 I closed at 4.97. My close about 4.95 today. The 2045 closed at 6%. I expect to close a bit lower today. So I expect to see huge subscription. Last auction was 5 times oversubscribed. So I expect to see oversubscription to that tune as well. Maybe about 5 times oversubscription as well today.
Now, tell us, what's responsible for the higher returns on FGN bonds as compared to the Treasury bills?
So the FGN bonds really is not that the return is quite high. I would even say that the return is low. So if you look at a 12-year, a 50-year bond, for instance, it's currently trading at about 7%. That is quite low. When that bond was issued, it was issued at 12.98%. So because of limited outlets, we've seen a lot of investors show interest in that bond, and that has pushed down the yield to currently at 7%. So the way the yield curve works is for lower tenor investments, the yield should be lower, and for the longer tenor investment, it should be higher. And that is what we currently have now. The yield curve is not inverted; it is a normal yield curve. However, in terms of where the yield should be, we think it's quite low. When you look at where our inflation rate is at 14.23%. That means people are having a negative return on investments. If you have inflation rate at 14.23% and a 50-year instrument is at 7%, that's a negative return of investment about 7.23%. So that's really a disincentive to want to put money in long-term instruments. That's the disincentive to want to invest in short-term instruments, and that's what we've seen play out. And I think that's what has even contributed to the rally we've seen in the equity market. The equity market has rallied and is really on steroid. So there's been a bit of pullback in the last 2 days, but really the trend is still we expect to rally because there's so much liquidity in the system and people don't want to invest at low yield. Good enough to mention that the treasury bill rate is quite low. 1 year at the last auction was 0.3%. The 180 day was 0.15%. So those rates are quite abysmal, and most investors will not want to put their funds in such low rates. So the bond is low, but it's, like you mentioned, is a bit better than what we have in the treasury bill market at the moment.
It's typical of fixed income dealers to, of course, return to the secondary market the morning after the auction to take position in unmet demands at the auction. But what's your outlook of the secondary market tomorrow?
So I expect to be bullish. That's always been the trend. So a lot of people that missed out at the auction, they want to cover their position. And we're going to see a lot of bullishness tomorrow when the result comes out. We expect to see a lot of bullishness. People that couldn't get at the auction, they need to fill their auction. The way it works is that people have allocation based on their portfolio, and certain money needs to be allocated to bonds. So rather than leave that money in cash, we want to get a bond instrument. So maybe PFAs, local asset managers want to fill that unmet position. So definitely a lot of bids are going to be unmet. Just about 80 billion, like you mentioned, is on offer. And like I said, we expect to see way in excess of that, probably about 5 times of that amount has been issued. So all those unmet bids are going to come back, and there's going to be a lot of activity in the secondary market tomorrow morning. And that's going to drive the yield down from where it's going to close at the auction.
We've seen real interest rates decline generally at the debt markets, yet yields keep sliding due to demand. So tell us, at what end of the yield curve are investors more concentrated now, and why?
So for the PFAs, the professional fund managers, because they manage long-term funds, and so a lot of their instruments are in the long-term bonds. And really because they are trying to immunize their portfolio. What I mean is that because you have a long-term liability, you want to have long-term assets. Also, the long-term yields were quite higher than what the short-term yields were. So rather than want to just invest in the low end, invest in the long end. And there have been a lot of investors trading the bond market. So you've invested at a higher yield. By the time you depreciate, that means your price has actually appreciated. So interest has really been at the long end of the curve. But now because the yield is not too attractive, so there's been a bit of pause at the long end of the curve, and we see more activity at the short end of the curve now. And because those funds have been almost maturities are short tenor. So those almost maturities have been invested in short-term funds. But after the auction, I expect to see some bullishness in the long end of the curve. But in terms of the total portfolio, really is more concentrated towards the long end of the curve.
Now, the DMO is expected to make the bonds coupon payment on Friday. Will that in any way be a catalyst for some interest in the equity markets where, of course, the banks and the PFIs have shown some interest lately?
Definitely. So it's going to be a catalyst for the bond market and also for the equity market as well. So there's liquidity, and liquidity can be idle. Those funds need to be allocated, and really investors always look for where I can get the best return. In the past, bond has given investors one is safe haven and also good return. But because yields are not at comfortable level at the moment, we've seen a lot of those money go into the equity market. I expect to see the same. So like I said, it's showing a bit of pause in the equity market, but we expect to see renewed interest going forward. So the bond payment, some of it will enter the equity market, some will also go into the bond market.
But with all of these now, how should investors trade the fixed income market?
So now is you need to properly allocate and align your portfolio. Now objective is key. In the past, for a lot of investors, they didn't really care about objective. And I will explain. So people have long-term liabilities, long-term obligations. You probably need to go and build a house or go for a master's or travel. Some of those are long-term projects. But because the long-term end of the curve was given attractive interest rates, if you backtrack about 3 years ago, treasury yield was as high as 20%, 22%. So really, there was no incentive to put your funds in long-term instruments. So that has changed now. So for investors that have long-term liabilities, you can play the bond market, you can play the equity market, because that provides capital appreciation benefits. But if you're having short-term obligations, for instance, it might not make sense to just put your funds in the equity market or put your funds in the bond market. So you need to properly align your portfolio. And really, for a lot of investors, they have an allocation strategy, depending on how much they can allocate to bonds, how much they can allocate to equities and money market funds. But just to round up the question, right, to properly allocate your fixed income instruments, try to immunize your portfolio. So try to put invest long-term funds in long-term bonds, and also look at your duration, for instance, outlook for interest rates. In the short term, outlook for interest rates is that yields are pretty going to remain short, pretty going to remain low. And if you think yields are going to remain low, you don't want to go too long. So you might want to stay short in terms of yield, and when yields improve, you can now go long. So if you have a long-term investment, for instance, long-term liability, it might not make sense to just lock in those funds now completely, because at some point yields are going to improve sometime next year.
All right, well, now let's just touch on some other issues now. Talking about inflation now at 14.23% and an expected negative GDP, what will be your expectations as the Monetary Policy Committee of the Central Bank meets next week?
So the MPC really, they are in a difficult situation. Is one that they are in between the rock and the hard place, and so it's quite difficult, and it's because there's no easy answer, there's no easy solution. So there's on one hand there is inflation, on one hand there's negative growth. So they need to make a decision that really balances everything. If you look at the body language of the MPC and last meeting, 6 of the members voted for a decrease in the monetary policy rate, while 3 voted for status quo and 1 person voted for an increase. So really the body language of the MPC is one to address the negative growth. And that is in line with consensus of most central banks around the world. They are dealing with COVID-19, growth has been slow, they've been locked down, economy is not booming, people are not able to produce. So really that is central to to what the MPC wants to achieve. So I believe they're going to go for an expansionary policy. I might not expect them to reduce rate now because they just reduced rate the last meeting. I want to see how it plays out for a few more months. So I expect a status quo at the next MPC meeting next week, and really that's to ensure that the policy action that was implemented at the last MPC meeting to see how it pans out. So I expect a status quo, but really the focus of the MPC at the moment is growth rather than inflation. Inflation seems to be a lost battle, and because the factors that cause inflation are cost push inflation, not demand pull. So inflation is really affected by 2 things, either a demand pull factor or a cost push. One is that there's so many farmers chasing few goods, but cost is really structural factors like what we have now in terms of farm incidents, what in terms of transportation, what we have in electricity. Those are structural factors that an increase in rate cannot address. And so really they can't increase rates to address that. So rather than just focus on what they think they can address, I really that is growing the economy and making funds available to the private sector and the real sector. So I expect to talk about the next MPC meeting.
Now, with all of these factors that you've mentioned now, how would you say investors should recession-proof their portfolio?
Okay, thanks. So that's a good question. So really, recession is an obvious fact, and it's facing everybody is in our face, and it's always good to recession-proof your portfolio. And really, because most people fall back on their investments to meet their needs. If your income is not enough, most times your investment is like a fallback. And at the moment, equity seems to be giving a lot of return. Equity gives you a capital appreciation benefit, also gives you an inflation edge. But one of the advice is to have a balanced portfolio, and it's always good to diversify your portfolio. Most times, you just leave the portfolio just concentrated in one asset class, and that can become risky because asset classes can flip. But if you have your portfolio diversified across equities, across fixed income and money market, you're able to take advantage of the various vagaries in the market. So one is to have a balanced portfolio of equities, bonds, and fixed income. It's important to play the fixed income market now. and it plans to play in the equity market now. So it plans to have some of your funds allocated in fundamentally viable stocks and not just any stock. Also good to have maybe some funds in dollar investment. And the reason is because dollar gives you an inflation edge and it also gives you a currency edge. So if you have some dollar funds, you can put it in dollar funds or you can put it in euro bonds. Euro bond yields at the moment currently offer either what you get in your local sovereign bond. So that can give you a sort of protection. So one is look at currency, if you are going to recession-proof your portfolio, and also diversify your portfolio. For the retail investors, I usually advocate mutual funds. Having some of your funds in mutual fund, because mutual fund is the way that professional fund managers help you to manage your funds. So you don't really need to think or what about the fundamentals of the company. Somebody is doing that for you and ensuring that your funds are protected and your funds are being optimized. So two things: one is to have some of your funds in dollar if you have dollar obligations, and also to have a diversified portfolio in equities, in money market and fixed income. That will help you to recession-proof your portfolio.
All right, I'd like to thank you, Acting MD at Cordros Asset Management, Bolan Aino. Thank you for sharing some of your time with us this morning.
Thank you. Thanks for having me.
All right, in other news, the Chief Executive Officer of the Nigerian Stock Exchange, Oscar Onyema, has been speaking on the benefits of privatization of public assets, stressing that previous moves have helped to expand key sectors of the economy. At a virtual summit on privatization in Nigeria and the outlook for subnational economic development on Tuesday, Mr. Onyema adds that while the federal government plans to revisit the privatization of public assets, there's also the need to bring it down to the subnational level in order for states to have a robust economy. Let's listen to him.
Privatization of public enterprises carries far more benefits beyond the immediate gain of bridging a revenue gap. It goes a long way in guaranteeing efficient, productive, and profitable entities by adopting a private sector-led model of intervention that benefits the economy at large. Hence, we witnessed the continuous operations and growth of privatized entities, some as far back as the first phase of the National Privatization Program in 1987. We are excited to lay emphasis on the absolutely positive outcomes of the program, which includes success in relieving the government of the burden of financing public enterprises, creating liquidity for the government to pay off debts and finance new expenditures, thus creating liquidity for the government, raising the level of investments in infrastructure. The market capitalization of the Nigerian Stock Exchange, through which the shares were sold, grew from 8.9 billion naira in 1987 before privatization to 65.5 billion naira in 1994 after phase one of the privatization program, and 428.9 billion naira as at the end of August 2000. The Nigerian capital market was deepened and broadened by the large body of shareholders created as a result of the privatization policy. On the national level, the National Council on Privatization, chaired by the Vice President, Professor Yemi Oshibajo, GCON, is the apex body charged with the overall responsibility of formulating and approving policies on privatization and commercialization. The NCP is actively involved in divesting government holdings in public enterprises and has privatized a total of 142 public enterprises, since the beginning of the privatization program. A shining example of the developmental benefits of privatization is the telecommunications sector.
We'll do an opening call to London when we return shortly. Do join us again. Welcome back. Now, just before we get to London, let's just do a quick recap of yesterday's trading at the NSE, where the market extended losses. Of course, this brought a 1.5% drop in the all-share index. But let's quickly bring in a stockbroker, Abdurrashid Momo, to tell us what to expect today from the markets. Good morning, Mr. Momo. Thank you for joining us on the program. How long will it take for the market to correct itself? When are we likely to see the bull return?
Hello? Okay, I can't hear you clearly, but the only thing I have to say about the market is, I've always said it before, the market generally is taking some corrections now, and I've said before that we have two types of investors we have two types of players in the market. That's the investors and the traders. Traders see a position where prices go up and they take profit, and investors are the ones that are still looking for value. Actually, what triggered the storm in market movement was the circuit breaker that triggered last week, putting investors in the way of caution in the market. But what I'll say is that historically, I've noticed the trend of the market that every 2 years, the market has a pattern of behavior where market trends between, let's say, in those periods, market trends about 20,000 points, and they fall down to say 20,000 points. So we'll see support levels between 20 to 19,000 points, and recent between about 35 to 40,000 points. So far, this is the third trend the market is going, and we've only made about 40,000 points. So there's still basically another 6,000 points to go from my calculations. So even if we're seeing some corrections now, in the long term, it's still the bulls still have more legs to go.
All right, stockbroker, Mr. Abdurrashid Momo, thank you. I'll just have to let you go at this point, but we do appreciate your time on the program. All right, Juliana Olayinka joins us now from our London studio for an analysis of today's headlines coming from the UK. Good morning, Juliana. PM Boris Johnson has announced plans for the government's Green Industrial Revolution, which he says could create up to 250,000 jobs. How much of a relief would this be?
Well, it would be a relief if those jobs are an eventuality, and we're not sure if they are. This is a plan, and it's a very ambitious plan, a plan that environmentalists have welcomed, but they definitely don't think that it goes far enough. This is really part of a strategy to level up the country, because a lot of these 250,000 jobs, which are potentially going to bring in billions to the economy, is really going to strike in the industrial heartlands of Britain, which is the Midlands and the north of the country, places that do feel as if they have been segregated by the British government and have been left far worse because of COVID-19. And much of it was already leaked to the media earlier this week, so I believe I spoke about it with possibly yourself or Chimeze about the ban on petrol and diesel cars, also a lot of offshore wind. Boris Johnson hopes that offshore wind will be able to power each and every household up and down the length and breadth of this country. So there are lots of ambitious sentiment, which I'm sure during Prime Minister's questions today, Sir Keir Starmer, the Labour opposition leader, will be challenging Prime Minister Boris Johnson. But of course, he is self-isolating, so we're expecting to see him zooming from his kitchen or from his bedroom. Very important to remind our viewers as well that next year Britain are going to be hosting COP26. This is the UN's climate summit, which was due to take place in Glasgow this month. But of course, that's completely been hampered by COVID-19. So Britain, with this 10-point plan, are really trying to push themselves forward. There is 10 points which I would have liked to have gone through you, but I know time is of the essence.
All right, Juliana. Now, the Treasury is planning to slash billions from the overseas budget from 0.7% to 0.5% of gross national income. What is the reason for this?
Some Treasury officials have always disliked the 0.7% that Britain does send to overseas to help in developed nations. They would rather spend that money within a country, but it is seen as some sort of soft power. Britain is one of the few countries in the world that does commit to this 0.7%. This is a UN target that was put in place a few years ago, and if the speculation is to be true that it will be reduced to 0.5%, then the Foreign Secretary Dominic Raab will have to give his reasons to the House of Commons, because it is legally binding. There are some suggestions that, of course, this is only happening because of what's happened to the coffers during COVID-19. We are in a debt that is pretty historical, over £2 trillion, and Chancellor Rishi Sunak is trying his best to try and find ways to fill up those coffers without having to put too much burden on the taxpayer. So they are trying to reduce this 0.7%. But of course, it is going to face lots of criticism. And that's because COVID-19, as we know, is likely to push already the less privileged and the less vulnerable into poverty. I think the last estimates from the UNHCR is that COVID-19 will push 100 million people into extreme poverty. So it's not a great look for Britain to decide to do this at a time when the developing countries do need their assistance the most. But according to a source at number 10 Downing Street, nothing is set in stone yet. It is purely just speculation.
All right, one last question, Juliana. That's the fact that more warnings about the no deal Brexit have been coming in. And this time it's from accountancy firm KPMG, which says it will cut the UK's economic growth by more than half next year. Could you tell us more about this latest warning? I'm afraid in about a minute.
Well, yes, it's interesting. And actually, KPMG have made this forecast presuming that we do actually get a deal with Brussels before the end of the year, and that a vaccine will be fully implemented across society so that these social distancing rules will come to an end. So really and truly, even though it does sound like a bit of pretty much a downbeat projection, this is a kind of best case scenario. They've really looked at manufacturing being a sector that is going to be particularly hard hit by Brexit, especially those who work in textiles, chemicals and electricals. They're expecting bottlenecks to cause disruption on Dover. We know that because I've spoken about that extensively on this programme. And they also touched on the labour market, currently at 4.8% unemployment. They expect that to rise to 7.8% in May next year, as, of course, the job retention scheme is keeping people in jobs, but there is likely to be much more losses of businesses and employment as the months go on, Bissy.
Thank you, Juliana. Do enjoy the rest of your day. And of course, we'll see you again at 1:30.
Thank you.
And back home now, let's bring in Akbawe Oputu, a fixed income dealer at Access Bank, to run us through activities at the fixed income space this morning. Good morning, and thank you for joining us. What are we to expect from the Treasury space this week, bearing in mind that investors remain unimpressed by the unattractive yields in the space? All right, the network seems not to be quite friendly at this point. But just before we wrap up the program, let's just once again do a recap of yesterday's trading session at the Nigerian Stock Exchange. Of course, we saw the market extend losses, and this came as investors sold off on the likes of Dangote Cement, Nestle, and Nigerian breweries. And this led to a 1.5% drop in the all-share index. The total volume of trades increased to 9.36 billion units, valued at 12.02 billion naira, and exchanged in 8,712 deals. UAC Property was the most traded stock by volume and value at 8.52 billion units and 5.96 billion naira, respectively. We hope to see what direction the market will take, if the correction will continue, just like Abdurrashid Momo talked about, or not. And that's where we wrap up today's program. Thank you for watching. I am Bisi Adebayo. So enjoy your day.